Welcome to Mid-American Money. I'm Ernie Goss, Professor of Economics here at Creighton University and Director of the Economic Forecasting Group at Creighton as well. Today we're going to discuss the economic outlook and looking at the economic downturn and how it's affecting startups and the overall economy in the Mid-American region. Today I'm joined by Tony Hendrickson, Dean of the College of Business here at Creighton University as well, my usual partner in crime. And today I'm very pleased that we have Steve Seline, who is the president of Walnut Private Equity Partners, a private company that has brought to the market large and small companies going public and securing capital. And as you probably are well aware of, it's very important in this market, looking for, finding, getting capital. So we're really happy to have Steve here today to talk about that very process. But first, let me review our survey, our September survey. We came out with the results on October the 1st. September survey of 900 businesses stretching from North Dakota and Minnesota in the north to Arkansas and Oklahoma in the south. And what that survey is telling us, these are supply managers. They are sort of the canary in the coal mine, if you will. When they see things looking good, it usually comes out good. When they see things looking bad, usually not good for the overall economy. So first off, the September survey results. The Business Conditions Index climbs to its highest level in 2 years. Now this is much like the national number that came out the same day, pointing toward growth in the months ahead. Unfortunately, not many new jobs. Inflation gauge indicates heightened inflationary pressures in the pipeline. Of course, that's not good news. The employment index moves above growth neutral for the first time since March of 2008. Now, that's a bit contrary to what we saw in the national numbers. It showed an economy that is expanding, but with loss of jobs. Now, we gained jobs, at least according to our survey, in this 9-state region. Regarding a public option, now we ask these special questions each time. Public option for health insurance coverage, 22% support such an option and 59% oppose that option. So again, our numbers just aren't matching up there with the national surveys. So overall, our survey shows an economy that's expanding, but without a lot of new jobs. I think when we look back on this period next year, when you look back, the recession ended in the third quarter of 2009. Now, it doesn't feel like it right now, but I think when it's all said and done, it will have ended in 2009. Steve, how has the recession changed your business? I mean, you're right there in the middle of it. Everybody's trying to find capital, trying to find operating funds. What's it look like from your vantage point?
The capital markets have basically dried up, and as you know, capital is dependent upon the future outlook, and so we're very much focused on what's going to happen with the economy. Everybody in the capital markets is looking ahead, and right now the big fear is the double dip. I think everybody agrees that the recession has stopped at this point in time, or at least bottomed out. The question is, does it go back into another recession? The government intervention into the economy is a dual-edged sword. It's been probably one of the reasons why it has come out. Right. But it is also, as regulations become more stringent and as people become more worried about what the government's going to do to the economy, that slows down the ability of capital to jump in.
So it's a lot of, looking out there, it's a lot of question marks. Like, well, everybody's on the sidelines waiting. Well, we're getting some direction. Would you say that's? Absolutely
true. And obviously when there's questions in the market, that creates opportunity. But the opportunity right now is one where everybody is held back, waiting, and the primary problem is that people now are having trouble getting bank credit, and so most of the deals that are getting done, if there are any deals that are actually getting done, are getting done with pure equity.
Like your company.
Yes.
Such as your company.
Yeah. So we have the ability, but most private equity is based upon the idea that we can financially engineer the deal so that it becomes leveraged to really benefit the equity that goes into it. And right now, it's very difficult for us to get any kind of leverage on our equity. Banks are lending at a much lower level.
So meaning that putting your funds up there, there's not any other funds coming in that can be leveraged.
Right.
So it's you guys are out there taking all the risk, and is this like Steve's saying, Tony? Is this we talk about a V-shaped recovery, boom boom, W-shaped recovery? Now I'm hearing this one take you back to your high school days, Tony. Square root. Remember that?
Right.
Square root of 64. What is it? No. Go ahead. What, Tony? How do you? I mean, back to Steve's point about granting credit. We have a lot of banks that we do business with. What are you hearing?
Well, I think Steve's right about this credit. I think it's important to note that the capital people with capital can do one of two things. They can invest and be an equity owner, or they can use that money to basically for debt, and they can loan it and expect a return on that. Now, what we have, I think, is an underlying problem is that the government's beginning to crowd out the capital markets because
back to Steve's point.
Yes, because they need the resources. Something that I want to share.
But now crowding out, you should see higher interest rates.
Eventually, I think we're going to get there. But remember, the government's been printing money, increasing the supply of money to fix that.
So the balloon, something's got to go out there, either higher interest rates or higher inflation, which is showing up in our survey.
Right. The government, if you look, the National Center for Policy Analysis released some figures in the last few days showing that as of August 31st of 2009, the federal government's annual revenues was $2.2 trillion. The debt that the U.S. government has is $11.8 trillion. That's trillions, not billions. In addition, Social Security, unfunded Social Security debt is $17.5 trillion. And here's the kicker. Medicare, unfunded Medicare promises currently is $89.3 trillion.
89 trillion. And the size of the U.S. economy is about $14.5 trillion.
Right.
That's for 1 year.
And so you got a government that has, almost $120 trillion.
Six times the size of the economy.
And it's only taking in $2.2 trillion in revenue. So obviously you see why people want to raise taxes.
Why they're depressed.
Because they have so much debt that the government has to somehow figure out how to pay for. And when the government needs to have that capital to finance its own debt, it takes it away from private equity, from other productive means of
it
capital.
provides some opportunities perhaps for private equity. Steve, I mean, you and I talked earlier about energy. Of course, cap and trade, that bill is before Congress has passed it, or the House of Representatives has passed it. Senate is examining it.
Right.
Now, what are you seeing? Your firm's taken pretty strong positions in energy, at least if I can say that. I mean, you're betting long on energy or short? I mean,
what we're betting on is the energy infrastructure right now.
Okay.
Eventually, the logical, reasonable, rational things that you're teaching your economics students that I learned when I was in economics class that says that natural gas should win. Natural gas is domestic energy, natural gas is carbon less, has a much lower carbon content. Natural gas is domestic. You could supply the domestic energy scene for a number of years off natural gas. All that being aside, there isn't anything in cap and trade that's going to make it. There isn't any natural subsidization like there is for wind energy or the other stuff. The government isn't subsidizing natural gas in the House bill, nor it looks like in the Senate bill. So it is a quandary. Wind energy is just not going to be enough to make this thing work unless everybody's got a windmill in their backyard. Exactly. So it's a difficult situation.
But you look for long term. If you got some money to bring to the table, energy's not a bad area.
Energy's not a bad area because you always need energy, and I think we are at a point in time where because the market has had trouble getting capital, there are some opportunities in terms of pricing. If you've got money to spend, there are some places where you can put it in. In the last 2 quarters, the energy sector that I follow has been up 14% each quarter. So there was a definite bottom in March where everything hit the bottom, and now it's beginning to come out. And we're still, according to my metrics, fairly far behind where the natural pricing is on some of these energy stocks.
Well, you know, Tony, you could take advantage of that by buying ETFs, electronic traded funds, so you spread your risk across many companies, not just one. So, Tony, what do you see? I mean, the Obama administration has threatened to raise, if China and India don't go along with our CO2 program of emission limitation of the emissions, they will raise tariffs on it. What do you think about that? I mean,
obviously, I think that's bad for trade. It's particularly bad.
How do you protect yourself, though? Is there a way of protecting yourself?
I'm not sure that there really is. I mean, I think that one of the things that we have to realize is if we're going to get out of our own recession, if we're going to address our deficits, we're going to have to increase exports, and you can't do that by poking the bear that you're hoping to deal with a stick.
Look no further back than Smoot-Hawley of 1930, I think it was.
Absolutely.
Where we raised tariffs and restricted trade.
You know, Ernie, let me ask you, the market measured by Dow and the S&P seems to be rebounding. Given unemployment, why is that? What do you see about the president's health care and cap and trade that seems to be appealing to a stock market?
Yeah, well, we're dealing in a global economy, and we keep we look at the stocks as limited by the U.S. economy. Well, you could have a recession. We're not going to have, but a recession in the U.S. economy. A global economy is expanding, so profitability could be growing even while the U.S. economy is coming down. So we have to get away from this obsession that the U.S. everything is all about the U.S. We got the Dow 30, which a number of those companies do more business outside the U.S. than they do inside. So you could have a rebound even while the domestic economy is not doing very well. So,
and I think sometimes that the stock market is somewhat bullish about the lower unemployment. I think the restructuring, they're not happy that unemployment is down, but they see the positive aspects of restructuring of businesses, and they see that as positive, restructuring of the allocation of capital, and therefore they see that as more bullish about where things are going in the future.
You know, and Steve, your company does, I mean, you have to look globally. We all have to look globally, but are there more opportunities here in this part of the country? And we have companies that are based here, do business here, and I have to say, recession, it has been lighter here than the rest of the U.S. So are there opportunities here, in cap and trade particularly?
Well, as a card-carrying member of the Greater Omaha Chamber of Commerce Board of Directors, I should be definitely pitching the idea that there are. We have the best workforce, as you well know, in the country. I mean, we're just very proud of what the workmanship and the energy level that we can get out of our people that work for us here in the Midwest. And I think we can definitely state that that has helped us weather this recession better than anybody else. But going back to what you guys were talking about earlier, cap and trade could definitely hurt the midsection of the country. The coast will benefit in the midsection of the country if you take a look at the energy framework that is out there and how coal, which is the great penalty, where coal is concentrated and where coal power plants are concentrated as opposed to the coast. I think we do have an opportunity in Nebraska and wind energy, and that's in the surrounding states, and they're already taking advantage of that in Iowa. But we would be penalized in the medium term. The next 10 years, we would be penalized by the fact that the coal costs would go up, and that would hurt our electricity generation, take away one of the great advantages that we have here in the Midwest, which is we have low energy costs. Yeah.
Well, okay, Tony, where does this create opportunities? If you're talking about investing, or if you're talking about a job, if you're talking about us, we educators, where are the opportunities that this is creating? I mean, we have to look out 5-10 years ahead.
I still think there is opportunities in areas like energy. I think there's opportunities.
As Steve, so you and Steve are both online.
I think energy,
energy stocks, perhaps.
You know, we're all going to continue to need energy going forward. There's nothing on the horizon that's going to say we're going to be able to do things without energy. So we're going to need sources of energy, and clearly there's opportunities for innovation to find alternative uses or sources of energy. There's also opportunities in healthcare. While we're trying to
some healthcare companies buying some of those stocks
selectively, and there's innovation. You know, one of the things that I think is going on, I think it's appropriate, and it's a good opportunity for us to be addressing energy and healthcare reform. Right now, we're really talking about more health insurance reform than health care reform.
Mm-hmm.
But there is opportunities there, especially if we will use reason and not political agendas in which how to address that. And that's the problem I have.
You know, and I see things coming out here, higher interest rates. I think we're all three saying higher interest rates. So
Absolutely.
if you borrow money now, if you can get it at a good rate, rates are very low. Mortgage rates, but again, back to your point earlier, Steve, it's getting the credits the hard thing.
Absolutely. And one of the things that we're seeing, and it's kind of, I guess it happens every time that you go through a great bubble like this, but the regulatory actions that are being taken by the government are almost as important as the money supply actions that they're taking.
Mm-hmm.
In other words, the local bankers are getting frozen in place because they have got regulators breathing down their neck telling them that they can't make any more commercial real estate loans because their commercial real estate portfolio is too high. Well, even if the price of commercial real estate comes down, if the regulator says you can't borrow for commercial real estate, you're done, and it's it compounds the effect on the commercial real estate market.
Right.
Let me give you an example. I just got an email from a buddy of mine. He owns property in Hawaii. A property that sold for $300,000 units, now on sale for $75,000 short
Wow.
sales. $75,000,
Wow.
and that's in Hawaii. And I can send it all you
Yeah,
the email. I'm like, $75,000. You're still like on the sidelines.
Yeah.
And the bank requires that they're accepting short sale. They're requiring you have the $75,000 in the bank. They're not going. You're not going to make an offer and not have the $75K. They're looking at it. So absolutely, there's some wonderful opportunities out there, but getting the money is not
Absolutely.
easy, and that's creating opportunities for companies like yours, Steve.
If you've got equity, you can make some difference now.
And the interesting thing about this is a lot of our political rhetoric is about making opportunities for the have-nots. And clearly, in this situation, it's all about more opportunities for the haves, not more opportunities for the have-nots.
Well, and the other opportunities, I think, tips, for example. We're going to see more inflation now. It hasn't come yet, but Treasury inflation-protected securities. We're talking about those. When the inflation goes up, those go up in value. They readjust for inflation. So I think that's an opportunity. Bonds, watch out. Bonds, I think, particularly on the Treasury side, there's so much priced into that in terms of risk. So when the risks come out, the prices come down, the yields go up. A lot of money to be lost. So I watch out for Treasury right now. Okay, let's talk about what economic happening indicator. I mean, what's a headline that you might? I mean, Tony, you got a headline? I mean, you were not too sure on this one.
Yeah, I think one of the issues that I see is right now the current administration is really almost fighting a two-front war. They're trying to do healthcare reform, health insurance reform, and cap and trade simultaneously. And I think you will see that they will either clearly stagger these, drop discussion of cap and trade to focus solely on healthcare until they can get that through, or surrender one of the initiatives.
So the headline might be administration surrenders cap and trade. It's not in those words.
Not in those words, but I think that they're going to have to. Right now, they're trying two major political agendas, having difficulty on both fronts. I think that if they're going to be successful on either one, they're going to need to focus their political clout and resources behind one issue, maybe one, and then address the other. But at the current rate in which they're trying to address both simultaneously, I don't think that's sustainable.
Steve, headline for next month.
I've got two headlines.
Oh, boy. Okay.
One's the pessimistic one and one's the optimistic one.
Well.
The pessimistic one is Israel attacks Iran. If that happens, then your economy is definitely going to be in a whole state of flummox. If that happens, and that's that's a real possibility at this point in
Then
time.
my idea of selling treasuries is not good. Treasuries is a place to go.
Treasuries would be a place to go, but the price of oil, your ETF
Yeah, oh,
idea
yeah,
early
yeah.
would be just
Yeah,
out of sight.
yeah,
That would
okay.
be a tremendous, and there is some of that that's built into some of the prices of oil that you're seeing right
Okay.
now. The second one, the optimistic headline, is that we make some major discovery in healthcare, to go to our earlier point. Somebody comes out with something that's going to solve diabetes, something that comes out that's going to take a major step forward in solving the cancer issue. Those kind of things happen, and suddenly that unfunded $89 trillion worth of Medicare becomes what I'm looking for, what I'm hoping for on the optimistic side is that we go over the technology curve, over the technology top, and all that money that we've been pouring into healthcare technology suddenly begins to pay off in a big way, and we start doing some things that really make a difference.
Maybe to Tony's point, buy healthcare. Who has that drug is the company that's going to benefit.
Absolutely.
Well, my headline for the month is that cap and trade fails. That cap and trade, I mean, it's not going to be it's probably going to be couched in different terms. It's not cap and trade fails, but beneath it, the subtext is cap and trade fails because, as Tony said, too much is going on right now, too much. And as you said, Steve, this is creating a lot of uncertainty out there, and markets don't like
Absolutely.
uncertainty. So that's my headline for the month.
I hope you're right.
Oh, yeah, you hope?
Yeah, absolutely,
Okay. So
absolutely.
we'd be happy if cap and trade
Cap and
fails.
trade failed, that would make the
Okay.
economy a whole lot better.
Okay, let's talk about the indicators we're going to be watching. Steve, what if you had a couple of economic indicators to tell our audience what they should watch out for, what would it be?
If you start seeing any kind of break in the commercial real estate market, any kind of deals being done in the commercial real estate market, that means that at that point in time, I will stop worrying about a double dip recession.
Okay.
But the thing I am worrying about is that there is lots of talk among my friends in the real estate business that there's still a number of shoes to fall in that business, and if that happens, that will slow down the economy again. So I'm
Maybe
really
a double
watching.
dip then. Back to your double dip. So Case-Shiller home price index is one?
I'm not so much worried about the residential housing.
Oh, it's commercial.
Commercial, I'm worried about a lot more. I think we've passed through, to a great extent, what's going on in the housing index.
So you look more toward the commercials and what's going on
I'm
there.
looking at some commercial REIT stocks, watching them because they have a fairly good predictive value for the commercial real estate
So look
market.
at the REIT stocks, the stock prices. Tony, what are you going to be watching?
Unemployment. I still think that we still want to keep watching unemployment. I do think that we may see the economy getting better and unemployment, the employment figures lagging. But I think it's really important that we keep an eye on that because ultimately, if our citizens are not fully employed, if we keep running, close to 10%, that's not really sustainable in a growth economy.
Okay, well, my indicator to watch is the Purchasing Management Index coming out from the supply chain managers, coming out first business day in November. Watch that number. If it should dip back below 50, very, very bearish. Above, say, 55, very bullish. So it's going to be an important first indicator for the month, so watch it there. Now the Federal Reserve, of course, they're like we are, sitting there trying to figure out what's going on. Tony, I mean,
They're
what are they gonna
out
do?
of what they can do from a
but
monetary
now they
policy.
meet in November, they meet in December, they meet in
Right.
January. They're not meeting in October. Is a rate hike in the cards?
I don't think so. I think that would put the brakes on what recovery that they do see
Okay.
is there. I think that they're going to be watching inflation very closely and
Are they going to be
potential
doing
interest rates.
anything other than just like we are watching? Is
Yeah,
that?
I think all of them will be printing money to increase.
Steve,
the supply.
what's the Fed going to do? Or can they do anything?
I agree with Tony and you. I can't see them raising any money. Again, going back to my commercial real estate, I'm definitely worried that if they did raise it, that would bring the second shoe down on the commercial real estate market. So I think they're constrained. I don't think they've got a choice in this deal.
What do we say? Between a rock and a
And
hard place. Yeah,
absolutely.
and I do think they are doing one thing, is sort of they're pulling back on their purchases of mortgage-backed securities, which is tending to raise mortgage rates, and of course that's not good. I mean, right now, And so they are caught between what we've seen and what everyone's seeing is more and more inflationary pressures. And the Fed is like, what do we do? We're talking about interest rates right now on the short end. The funds rate 0 to 1/4%. This is the lowest since the Fed was formed in 1913. Obviously, it can't go any lower than that. It's back to the point, Steve. What happens if we do get that negative indicator in real estate on the REITs, as you said? And thanks for that. That's a great indicator. What does the Fed do?
I think what the Fed will do and what the government will do may be two different things. But I think the Obama administration will see this as an opportunity to take that second stimulus package that you saw them start to talk about this weekend.
Yes.
And if they press that accelerator on the second stimulus package, then that will be the answer. But the Fed doesn't, you guys are the experts, but it doesn't look to me like the Fed's got too much more to go. They just don't have any weapons.
No, and that 6-shooter, all 6 bullets are gone.
Yeah,
Tony's used that before.
You know, it's like a handyman with a screwdriver and a hammer, and now the screwdriver's broke. So
and the hammer's gone too.
Yeah.
I mean, what's a person to do? And I mean, they meet again. But I do still think we could be in for the worst of worlds, which we call stagflation, of course.
Absolutely.
With energy prices, back to your point, Steve, of higher energy prices potentially, and then more and pushing inflation up at the same time we're in a recession. Of course, that means the Fed is in a double tough period.
And your earlier point about tips will look really, really
good.
good.
Yeah, tips will look great, but then you're looking for a place to hide.
Yep.
It's just not a good economy out there, and back to the political, what's going on in the Middle East with Iran is certainly huge and has implications on energy prices, bond prices, and of course stock prices. Well, hey guys, thanks for putting it all together, and Steve, thanks for joining us today. And Tony, as always, your insight is greatly appreciated. And thanks to all of you for joining us for this broadcast, this podcast today, where I think we've really addressed, and I think 2 guests here have really provided some insight and some important economic factors going in, particularly on the credit side, with Steve with Walnut Private Equity Capital. Thanks to him. Thanks to Tony for joining us today. And come back again in November when we'll be back for our podcast, and may your economic cup runneth over.